And Anthony, thank you so much for joining me as we wait for people to come and join us, because I know this is going to be the high part of everyone's day. Why don't you take this lovely moment to read out the Mackie research disclaimer?
That would be a good idea. Compliance happy. Let me just trying to get my. All right. The information provided on this podcast is for informational purposes only, and it is not intended to provide specific financial, investment, legal, tax, or accounting advice, and should not be relied upon as such. The contents of this podcast are not a solicitation to buy or sell securities. Mackie Research Capital Corp is regulated by the Investment Industry Regulatory Organization of Canada and is a member of the Canadian Investor Protection Fund.
I loved it. That was music to my ears, Anthony. Well, listen, why don't we jump right into it? Anthony, thank you so much for joining me. Anthony Sandler is an investment advisor with the Barber Group at Mackie Research Capital Corporation. We had the opportunity to have this discussion. I believe it was somewhere around April 1st. I cannot believe that we're sitting here and it's April 29th and we're both still in our homes. Almost an entire month has gone by. So I really appreciate that you're joining us and we can kind of have a bit of an update of what we've seen over the past 4 weeks. Why don't you start off by letting everyone know a little bit about the Barber Group and the practice that you have?
Absolutely. The Barber Group, as you mentioned, is part of Mackie Research Capital Corporation, which is a full-service investment dealer. Full service means we can advise on a very wide range of securities, from stocks and bonds to hedge funds and new issues. Barber Group is a team within Mackie's Vancouver office. We offer two distinct services that we like to think of as wealth creation and wealth management. On the creation side, we focus on early-stage companies with significant growth potential. And we offer trading strategies with the goal of producing positive returns. On the wealth management side, we advise clients on investment strategy, portfolio construction, and an emphasis on customization of clients' unique needs that we feel is lacking in the marketplace today.
That's awesome. And like we said last time, I love that you guys offer both wealth creation and wealth preservation as part of your practice. Why don't we jump into, talk to us about what you've seen over the past 4 weeks?
Well, I think a sort of complacent optimism has set in, which has pushed equity markets higher and has kept credit markets loose, by which I mean lending is still going on, as can be seen by narrowing credit spreads. Investors are hopeful and banking that a treatment is going to come soon. As we can see today, Gilead Sciences announced positive results from their test of their drug remdesivir, which is an antiviral. It showed that a 5-day trial had a 50% of the patients on it showed a marked improvement. So that's hopeful. The federal government in the US is clearly pushing for the states to reopen as soon as possible, and numerous states are doing so. Generally speaking, I think investors think we're through the worst of it, and that they're pricing in almost a full return to normalcy. We still do see fear in the treasury markets, with credit interest rates on US treasuries still those historic lows, which means that large institutional investors, tend to be the smart money, are still willing to accept negative real returns, which are the returns after inflation, in exchange for the certainty that their money will be there in the future, even if that money is worth less than it is today.
Okay, well, this might be a crazy question, but why would they be okay with their money being worth less than it is today?
Well, you know, the certainty that most of it is coming back is the real thing. And the question of why it would be worth less today is, I guess, inflation can be viewed as a measure of the value of currency. Very simply, if you add more money to the money supply today, then each dollar is worth than it was yesterday. Governments are spending massive sums to prop up the economy, and those sums are coming from the treasuries and the central banks, from the treasuries. The treasuries issue debt in the form of treasury bills to pay for all of this. And to ensure that the credit markets don't seize up from this oversupply of debt, the central banks around the world are buying vast quantities of these treasury bills and other debt. And to fund this, they basically print new money. This process is called debt monetization. You'll have heard it a lot lately, and it's going to have massive effects on various markets.
I want to talk about some of the effects, but do you mind maybe giving us your thoughts on is this a good thing or a bad thing that investors are becoming a bit complacent, or that they feel that we've gone through the worst of it?
I mean, I think I'll speak to this later as well, but overall, I think complacency is always a problem, and it's kind of wishful thinking. I'd rather be wrong on the side of caution than right on the side of chasing returns. But you never know with the stock market. I mean, this could be, everything could be hunky dory and we're back to full steam on the economy, in which case a lot of people will look very smart and some of us will look a little too cautious.
Yeah, right. Why don't we jump into some of the effects that kind of this, the printing of capital, what the effects of those are going to look like?
Yeah, I can certainly speak and point out some of the more interesting ones. So when money is worth less, then holding money is actually a negative, and the cost of money is represented by borrowing is low. So this is quite bullish for ideas and for innovation. And we saw this over the course of the last bull market, that companies with great ideas and visionary management were rewarded not in spite of large levels of debt and the lack of profitability, but almost because of it. Value stocks, so companies with good balance sheets, positive cash flow, and stock prices at lower earning multiples just didn't fare as well. Over the course of the bear market so far, we've actually seen this leadership of growth stocks continue, meaning they fell less when the sell-off happened and they've actually recovered more. So investors are still not rewarding prudence.
Do you think that is sector specific or the markets as a whole?
Well, I think in general, you're going to reward companies that are spending money when it's cheap and they're taking risks to bring their ideas to life. Many of these companies don't have bricks and mortar physical locations. And I think that helps on the tech side, for example, where everything is online. And a lack of a physical supply chain right now is definitely going to help. And then there's also the productivity per employee. So those are two big factors that I look at now and that people have been looking at over the last 6 or 7 years of the bull market. But yeah, I mean, it's not necessarily sector specific, it is company specific, but you're looking for companies that are willing to take on investor money and turn it into, real growth ideas.
Well, I asked that just because we have, we've had in this bull market, we've had a bunch of emerging sectors that have, had some runs, and again, we're seeing that sometimes the fundamentals, sometimes them being, able to spend money and try and create that value hasn't been as rewarded on the fundamental side. So seeing some of these emerging sectors getting a lot of attention where maybe the fundamentals aren't giving them the support that they might need. So just wondered if you had a thought on certain sectors, kind of seeing that more than others. Speaking of sectors, do you want to maybe jump into gold a little bit and what you're seeing there?
Yeah, another winner from inflation in the past has typically been alternative assets like gold, also art, collectibles, wine, real estate. The main reason for all of these to do well is that the cost to buy them goes up as the value of money goes down. So, in today's dollars, gold is worth more than in yesterday's dollars if the dollar is worth yet less. So we saw this in 2009 through 2013 with gold and throughout the last decade in the art markets. And I'd like to go a little further into gold, actually. So it's a store of wealth. It's a way of keeping your earnings and all the capital you built up in a physical, solid thing that can't be devalued by central bank activities, that is not really reflective of the economy. I think it's an essential part of any investment portfolio, and your allocation to gold really should have been going up as the bull market, got into a long in the tooth, we could say. Gold is great because you can buy it physically, you can put it somewhere safe. You can also hold it through gold trusts, which are exchange traded units. And they give you a purple gold reserve, the cost to maintain that reserve.
Hey, Anthony, I'm just going to stop you for a second. It's just glitching out. We might just need to give it a second to take a breather. What I think that's one thing that's really interesting is that no matter the level of sophistication of any investor in the market, the one thing that people do have some form of understanding on is gold. you know, and how it will react, you know, in good markets and bad. And I think it's definitely one place for us to look at as a safe hold, in the sense of we don't understand what's happening in the market right now based on our, you know, current pandemic situation, how the economy is going to react to it. But what we do understand is gold. Oh, hey, listen, I went on my own tangent about gold, but why don't you finish up? You were talking about gold and how it's being affected right now.
Where did I leave off in terms of like the gold trusts or getting into gold equities?
We haven't gone into gold equities yet. Let's start there.
Sure. So, opposed to buying physical gold or investing in shares of a gold unit, gold trust, you can also invest directly in the equities of gold producers and gold explorers. Typically, we see the value of the producers rise first. And then as the market gets heated up and there's more cash available for acquisitions, then we start to see market cap expansion in the exploration market, which is really a very exciting time, as I'm sure you know. Gold miners are going to benefit doubly here from elevated prices if they come from inflation, as well as lower energy costs with oil prices being down, and that means gas prices are down, diesel prices are down. We've seen some interruptions in operations for some of these gold producers. Some have come back online, some are still offline. I really think the value of a gold equity is going to be measured by their reserve more than anything, and their operations are going to be more of a discount or a premium to their net asset value of those ounces in the ground. Another option, of course, with gold is streaming companies, which invest in producing and developing mines in exchange for a royalty.
Well, and I think that's something that's also important to remember is it's, you know, it makes its way down the road. So there's the producers, you know, and how they manage their asset, as well as then goes into the, you know, to the exploration side. And the exploration side, if there's money flowing into that, typically, you know, we've seen a fairly robust market around that. Wouldn't you agree?
We've definitely started to, but if you look back to 2010, 2011, and then getting a little bit later, we really started to see that heat up towards the middle to late stages of the gold cycle. Again, when M&A activity really picked up, and then, you know, 5-cent stocks became 40-cent stocks, and up and up, and there's some real big winners that get to $5 or $6 and make everyone very wealthy.
Right. Well, listen, you said something interesting earlier. You talked about art, wine, and collectibles. What's the deal there?
Well, I think the best way to invest in wine is very short term, pretty much from the time to get to the store back home. Wine and art are specialties that I leave to others. There's a few indirect ways to invest in art, which go through the auction houses. And there's even hedge funds that are buying wine. You know, you're just investing in a fund of wine, which is kind of cool. It's another alternative and another way to get invested in something that has very little to do with the overall economic market. And again, it benefits from those cheaper dollars.
So the wine maybe...
Sorry, I was going to say, I do think we'll see more and more opportunities in that space over time as people get creative and funds get creative.
Well, I know that there definitely was a surge in delivery of wine over the past few months.
Definitely.
Okay, what about real estate?
So I think real estate is a great investment in most times, and I like to use real estate investment trusts. I like the idea of somebody else doing the work, to be quite honest, and getting the scale that I could never get on my own, as well as the diversification that you get across geographies and exposure to specific sectors. There's going to be some challenges coming out of this pandemic, so it's really important right now to be selective of where your real estate investments are going. Malls and retail are obviously going to take a hit right now, and there might even be some long-term changes to people's buying patterns. So we might see rents come down in some places as the mall owners struggle to fill stores. There is already that trend to online shopping, and I think if anything, this has hurried it up. Industrial real estate is another sector, and this one is highly correlated to the economy. It's about the movement of goods, the production of goods, storage of goods. There's going to be some very good opportunities to buy in at low prices and lock in good yields. Again, you have to be very careful to make sure that the company is going to be solvent and that they're going to be able to lease out all of their space. So look for good management, good track records, and patience. I think is really something to be. Should be patient with the industrials. I think one of the more interesting ones is going to be office space. So the pandemic is definitely going to have people thinking about how much space they actually need. If their employees can work at home, So I do think most companies are going to return over time to some sense of normalcy, but we could still see some downward pressure on rents, which would negatively affect the cash flows of some of these commercial real estate trusts. Overall, I do think that the net asset value of REITs is going to come under pressure. I think the real estate values are going to come down a little bit, just from maybe a lack of activity, if anything, if not from the economic contraction. So that would be a good opportunity to invest in some real estate companies that have sustainable cash flows, but maybe they've taken a markdown on the value of their properties.
Well, and I think the real estate, that's an interesting topic because there's also going to be, I think, some speculation on maybe some markets that were overvalued and how that's going to affect, the future value of those markets. And perhaps we're going to find some, undervalued areas in the real estate market that might really get to finally see a little bit of light. I know in Vancouver, it's always been a big part of discussion that we look at value of real estate. And I think we all feel we know where it's going to go, but there's definitely going to be some winners that come out of this in the end, and potentially some people that deserved a bit of a correction, or some markets that deserved a bit of a correction that are going to really see it at this stage. Which is also an interesting thought because we're entering a time where there is an entire part of our society, especially in North America, that are the baby boomers, and they're retiring and they're wanting to sell their larger homes, and probably built very, heavily into their investment model, what they thought the value of their home was and how their life would look like. So I do think life will look a little bit different after all this, especially from the financial planning side, which I know that you're heavily involved in with your clients. Do you have any comments on that?
Oh, definitely. If your financial plan involved the sale of your house in 5 years, for example, that might have become 2 years or 1 year because all of a sudden your retirement savings have gone down by 10, 15, 20%. We might start to see a bit of a rush for the exit. I've always felt that at some point the baby boomers would start selling en masse and really put some downward pressure on real estate, hopefully in Vancouver and Toronto, where it's just really hard for the younger generations to get into those single family homes.
Totally.
And, if people need to move up their timeline and people are already feeling a little bit anxious or there's a bit of fear, that might drive it a little bit further down and a little bit quicker than I originally thought. So. Yeah,
absolutely. Yeah, it'll be a good time to go revisit your financial plan after this is all said and done. I can't have this conversation with you without asking about oil. It's pretty interesting what's happening right now in that sector. What are your thoughts there?
Well, it's just, it's been pretty crazy. There's been negative pricing on oil and a very big depressed price on oil. It was caused by a massive drop-off demand from the shelter-in-place orders, as well as production increases at in March by OPEC. You got next to no air traffic. You've got much less driving going on. So oil storage at the airlines and at the refineries is full. Basically, if there's nowhere to put oil, then you're going to have to pay people to take it from you. So I think that's what we saw.
So sorry, so that explains why it's negative prices. So when people are seeing negative prices in the news, that kind of describes it a little bit.
Yeah, basically there was nowhere for the oil to go. So people were left holding these contracts, and the typical buyers at the end of any contract are people who want oil to fill up their storage containers or immediately refine it. If they've got nowhere to put it, then you're left kind of holding the bag, and you guys say, look, I'll make it better for you. I'll pay you money to take my oil.
Wow.
That's not sustainable. I don't think these low prices are sustainable. It really depends on the speed at which we get economic capacity back up, but also over time the refiners will create storage again as they refine their product. The airlines are still flying, so they'll use some of their jet fuel and burn it up, and they'll need more. And then on top of it, you've got OPEC Plus agreeing to a production cut. So the Russians came back to the table with the Saudis, and we're going to see about 10 million barrels a day supposed to be cut from both of them. Here in North America, it's not as quick as turning off a tap. Like taking production offline takes a bit of time. So as that production comes offline, we'll see some stabilization. I still think because demand is going to be low for some time that those prices will remain low, but I don't think we'll see negative prices that many more times, if at all. I do worry for Canadian oil producers, and more so for our exploration companies. One thing that's kind of glaringly obvious right now, if it wasn't before, is that the price of oil is engineered in some way based on the amount of production coming out of OPEC countries and a few other large producers. So it's hard to be at the whim of other countries with something as important as one of our biggest resources and one of our biggest industries. It's going to be interesting to see where oil demand goes after the pandemic. Some of the variables that you can consider are how quickly and how much air travel returns. Are people going to be comfortable flying? On the other side, are people going to be less likely to take transit? Are they going to be relying more on their personal cars because they're afraid of being around people? Online shopping, if people aren't driving to the malls, but fleet companies are delivering packages. Well, fleet companies are good at economizing their gas and diesel usage. Diesel is also an easier refined product. So maybe that would actually decrease demand if people are staying home to shop more.
Well, I've had a lot of people already, personally talk to me about planning, renting an RV this summer and getting out. One is spending their tourism dollars this summer locally, so within British Columbia or Canada, and secondly, kind of doing the we're going to buy a truck or we're going to buy an RV or something along those lines. So we will probably see some more kind of at home spending.
Definitely. And also to that point, I mean, cheap gas is going to, I think, put the brakes slightly on the growth of the electric car. It's been doing gangbusters,
Yeah.
selling a lot of cars, all the companies are investing. Well, if gas is cheap all of a sudden again, and, it's here in BC in the high 80s,
Yeah.
maybe people reconsider their decisions on spending a bit more on the electric car. And maybe governments don't have the money to subsidize the electric cars like they have been. So, that could also increase demand for gasoline and in turn oil. I feel like this kind of brings me full circle to the top. We were talking about how investors are viewing the recovery with rose-colored glasses. Similar to the oil market, there's going to be uncertainties in almost every sector where, how is behavior going to change? How soon will behavior return to normal, and what will that normal look like? I think there's going to be some positive results from the pandemic, but I think most effects for the midterm are going to be negative for earnings and for the growth of those earnings, and that's how we price stock. Last time we spoke, we talked about today being the day that the first quarter GDP numbers came out, so we get our first real sense of how the overall economy in the U.S. at least is being affected. The U.S. economy contracted by 4.8%, which is the largest contraction since the first quarter of 2008. That's a big number.
It's a big number.
And you really have to consider that the lockdown, shelter in place only really started in the second half of the last month of that quarter. So, the second quarter is probably going to be a lot worse. I've seen numbers as high as 40% contraction. I don't think anybody really knows the depth of it, but we're going to start to see. I said last time that we need to start getting some visibility into the future, and that's coming now, and we can really start pricing things out. Based on that alone, that GDP print, I'm comfortable with taking a cautious approach. And I want to point out that the fear of missing out is a very strong emotion. So we've seen this relief rally kind of extend further than a lot of economists definitely would have said, a lot of analysts have thought. It makes us want to get out there and chase stock returns. I like to think of my caution as a bit of a hedge. If the stock market gets right back to where it was and I've got money left on the sidelines for myself and my clients, well, that kind of means that the pandemic is over and that things weren't as bad as they had seemed they were going to be, which is a good thing. That means there's going to be less people sick and less people dying, and great. I would take that over my personal returns any day of the week.
Oh, 100%. Anthony, you're such a great guy. One last question I have for you, which is a little off topic of the broader scale of the economy, is obviously you and your group are more involved in kind of the small cap space, some of the private placements that are going on, some of the financings you might be seeing a little closer than some of us. Any comment on what you're seeing, if there's a certain sector that you've seen more come to the table, or what investors are more willing to put their dollars toward within that small cap space?
It's funny. Yesterday, our syndication department at Mackie was very busy. They had a bunch of deals come out. I don't know if I mentioned this last time, but people in in the speculative side of the business can only stay on the sidelines so long. It's a pretty big rush to go after those small caps that turn into good returns. So we're starting to see a bit of life breathing back into the venture side and into the new issue side. Definitely the mining side is where the most of the activity is, but we've seen a couple of cannabis deals again, and I know that the cannabis companies are actively looking for capital right now. We'll see lots of tech ideas coming to the fore as well, and all sorts of new wonderful ideas that are going to come because people are so resourceful and creative and inventive. And times like this where there's challenges, that's when I think you start to see the best and brightest come forward, and they'll be looking for capital to get their ideas off the ground.
The innovators come to the table, right?
Yeah.
Well, listen, I can't thank you enough. It's always a pleasure to get your insights. You know, obviously we hope to have you as often as you want to come and share your thoughts on what's going on in the market. It's super helpful to all of us trying to understand. There's so much content that's being thrown at us these days. I do really appreciate kind of the way that you approach information, bring it to us in a digestible way. So thank you again.
No problem.
Let's definitely do this again in May, and we'll see where things are at then.
It will be interesting to see no matter which way everything goes, but I'm hoping that, you know, that we get either a treatment or the spread of this virus really slows down, because we all need to get out and we all need to keep our doctors and our nurses and our healthcare staff safe, as well as our elderly and the long-term care homes and the workers in those homes.
Absolutely, absolutely. And just for anyone who's listening, you know, we did touch on a bunch of topics kind of within the market today. If you do have further questions, you can always reach out to Anthony. I believe all of your information is right on the Mackie website. Is that right, Anthony?
Yeah, you can go to barbergroup.mackieresearch.com as well, and it's there. And you can reach out through Instagram or through even through, and I'm sure she'd be happy to pass my information on.
Always happy to pass along. Thank you again, Anthony. Have a wonderful day.